All right, so let me say hello and welcome to another whiteboard lesson. Doug here with the LincolnList.com. Today I'll be talking about why you probably shouldn't be trading first thing in the morning and why you shouldn't be trading later on in the day. As always, if you like this video, click that you like it. If you want to keep up to date with the educational content on this channel, like the whiteboard lessons, the happy hours, the market mutterings, you can do so by subscribing to the channel. Now, this video is intended for those of you out there that are struggling traders, that are inconsistent, aspiring traders, or those that are new to trading. Those of you out there that have a defined system and a success rate first thing in the morning, this doesn't apply to you. And the reason I want to cover this topic is because when we start out trading, it's common for us to focus or be heavily focused on setups. You know, we live and die by our setups, our indicators, and all that good stuff. But one thing that's very easy to overlook for a trader is at what time of day do they actually decide to execute that trade. Because even though the market is open for 6.5 hours, that doesn't mean that all 6.5 hours offer a plethora of opportunity and a plethora of volume. There are certain periods of time throughout the day where your success rates are going to be higher. So for example, if you happen to be a breakout trader, the way that pattern will work first thing in the morning, the way that will work in the afternoons, and the way that it will work later on in the day could be three separate things. So it's very important as a newer trader or a struggling trader to pay attention to what time frames you're trading. Because if you're looking to capture the big moves, which I assume you are, they are likely to happen within a certain span. So what I'm going to do is draw for you today a timeline and how normally the market works. Again, this is not gospel. It doesn't work like this all the time. There are opportunities at odd times throughout the day. But when we're talking about trading, remember, we're always referring to a body of work. So it's not about one trade. It's about 20 trades or 100 trades. So if we kind of look at a day going like this, and I'll use Eastern time here, the market opens up at about 9:30. Now when I talk about, not almost, it does open up at 9:30. So when I talk about the first parts of the morning, what I'm really referring to is the first 5 to the first 10 minutes. So we're going to draw to say the first 5 to 10 minutes of the open right here is generally a tough time for a newer trader to make a trade. And the reason for this is you've got quite a few groups that are all piling in at the same time. So if you're the trader out there that wonders, how come I keep getting stopped out first thing in the morning? How come I thought it was going to do that, but it tricked me? I got faked out. Well, there's a reason for that. First of all, what you have in the morning is a bunch of orders that have been parked overnight. So a lot of people, or investors I should say, will make trades or make trade ideas, and they will put these orders in to fill when the market opens. So you've got a basket or a large handful of those. You also have scalpers or very, very short-term traders that are trading from tick charts or possibly 1-minute charts, those types that are looking for early morning aggressive scalps, and that's it. But then you have the biggest enemy of all enemies that piles in at that time, and that's called emotion. I know each and every one of us has been in the situation where we've just got up and we wanted to seize the day, right? We're like, I'm taking control of this day. I'm going to kick the market's ass. I'm coming after it. And then you just go balls in right when it opens. And then you're like, what? Right? You guys have been in that. I've been in that situation before. So then you're getting all that emotion. Now, the reason I refer to it as the most evil is because what's happening here is that there's a lot of people trading that are trading just on emotion and not on concrete trading strategy. And when you do that, you are in essence no longer a trader, you are a gambler. So you are gambling, and those emotions lead to poor decisions. This is why oftentimes in that early period of the morning, the first 5 minutes I'm talking about mainly, maybe even 10 minutes, those first period of time, that's when it's easy for a trader to be fooled, to be tricked out, to be stopped, or to allow emotions to cloud their judgment. Now after that, I'd say about between the 15 to the 30-minute mark is when you're going to start to see a little bit more clarity in how the market is working. So when you're looking at a stock, let's say it goes straight up the first 5-10 minutes of the day, it's hard for you to just buy that. If you're buying that, you're most likely buying that off of FOMO, or you're buying that off of an emotional impulse. You're not buying that off of a legitimate technical analysis approach or a fundamental analysis or some sort of structured plan approach. But as you come into the 15-minute, especially towards the top of the hour, this is where reversals or clearer moves are most likely to happen. So let's first talk about reversals. If you're looking at a stock that's going straight down, it just starts from the open and just dive bombs straight down. What's causing that is a combination of things, of people being stopped out, and then of course the ultimate of evils, the emotion. People are panicking out of it. After that, the emotion starts to remove itself from the market, and more clarity and more data, news events and other things like that have already come out to impact the market. And you start to see the market settle into a pace, or a stock I should say, settle into a pace and settle into a rhythm. So you're going to start seeing what we call secondary waves, or moves that have been digested, such as flag patterns that go up, they trade sideways, they're ready for another move upwards. Or you're looking for stocks that reverse. Now there's also another reason for that. It's not just necessarily emotions starting to slowly leave the market. It's also more data coming into the market with the news, but it's also you're starting to see different types of traders enter the marketplace. So all these traders that are trading off of 30-minute charts right here are now entering the market. So when you're starting out in that very beginning portion of the day, you have overnight orders, you have scalpers who are using very, very small charts, such as 1-minute charts. When I say small, I mean 1 minute or tick charts. And then you have emotions. Then once you start to remove the emotions out of that and move the scalpers out of that, and those orders have already been filled, you are now left with more patterns with continuity, a cleaner projection. And now you start getting other traders who use 15-minute time frames, 30-minute time frames, 1-hour time frames. They start to slowly enter the market. And it will be from this period, I'd say from this from the 15 minutes, 20 minutes into the day, all the way up till about noon, which is lunch, this area right here, between 10 o'clock and 12. That's where I'd say 85% of all traders make their money. That doesn't mean you can't make money in the pre-market or first thing in the morning. It doesn't mean you're not going to make money later in the day. But this is when the majority of the money. So if you only had one time frame, you can only pick 2 hours out of every day to trade. This is when I would trade, would be basically 9:45 to 11:45. That would be the only time, if. So I would think that if you look back at all of your great winning stocks, your great winning trades, most of those trades would have taken place between this first 10 minutes and that 2-hour time frame up to lunch. That's when you're going to see those bigger moves. And again, the reason for that is because as the day progresses, emotion comes out of the market, news has already been processed by the market, and then things start to develop. So at this point, you have more data. You see charts setting up, you have concrete support levels, concrete resistance levels. You have a better picture of what's going to happen because the market's had time to process that. Now, why this matters so much to you as a trader is because it's difficult for all of us to keep ourselves completely focused and have a high level of concentration, a performance level of concentration for an entire 6.5 hour period of time. We can't stay that focused all day like that. We have to kind of pick and choose our battles here. So you want to be completely focused, free of distractions, and totally into what you're doing, all in. And now, I'm saying all in, I'm not saying all in financially. I'm talking about all in emotionally, all in strategically. This is when most things good will happen for you in trading. So remember that when you're making these trades, if you're looking at a breakout, the success rate of that's going to be much higher through this period of time than it is first 5 minutes in the morning and then when we get here later. Now, speaking of later, after lunch, we're going to talk about possibly 1 p.m. to 3 p.m. As you get into these areas, it doesn't necessarily mean things don't happen at all, because sometimes there is opportunities, but the opportunities get fewer and fewer and fewer. And there's obviously reasons for that. So number one is just flat out volume. If you look at any sort of volume chart on any stock, you're going to see it normally peaks in the morning, flattens down during the day, and then there's a small spike towards the end. Just about 100% of every chart that you have is going to resemble that in volume. So again, let's go back to talking about breakouts. If you see the same exact chart here, a breakout chart here, and the same exact pattern here, which would the likelihood, which one would work out better, or which one would have the better chance of working out? The answer to that would be this one. Now, it's not going to be that way at 100%. This is the stock market. It does whatever the hell it wants to do whenever. Nothing's perfect, but remember I said it's a body of work. We're talking about tons of trades, not just one. But the statistics are going to favor you here. Because what do you need to have that breakout to work? If you're buying something, anything, what do you need? You need more buyers. You need people to buy it for higher than what you paid for it. So if you have more people here, chances are higher. If you have less, then that's what you're going to run into. So kind of keep that in mind. Also, there's sort of this thing where bigger houses such as Goldman Sachs, JP Morgan, and places like that, this is where a lot of their interns trade. So the moves that you typically see in there, because they're lower of volume, they're less reliable. And there's a lot of fake outs and shakeouts. There's also an emotional element to this as well, because all of the people that did really well here, they're not trading over here anymore. They've already made their money, they're done for the day, and they've moved on. The other people are the ones that lost a lot of money here, and then they just have no more emotional capital to devote to this market. They're just done mentally. There might be a few scragglers around waiting for a revenge trade, but that's all the participants that are going to be here. So kind of remember that when you're going through this, the time frames define the participants in the market. And as you get to the last hour, I'd say really the last half hour, what you're really seeing here in this piece is traders that are jockeying for position going into the next day. There's some good success to be had here at certain times, but if you're struggling already or you're not consistent, I would say to stay away from that, because you are forcing yourself into having a trade that has to work out in a very, very tight frame. So if you're making if you're a day trader and you intend on closing the position, that means the trade you're making is only going to last a half an hour. So if anything happens, you have no room for error, or you have to hold it overnight. So it's not necessarily where a struggling trader. Again, if you're somebody that's successful, you've got a pattern, there's places that you can make money in and out the whole entire day. But if you're really struggling and you're not consistent, not only one of the reasons is maybe not having the right execution, it's when do you decide to execute that trade? That makes a big difference. So in a quick review, what you're getting here in the first 5 to 10 minutes is you're full of scalpers, orders that's been left overnight, and emotions. Between this time frame, things have begun to settle. Now, there's still going to be fake outs and shakeouts and emotions here, but there's going to be a whole lot less because we have data, right? We have data, news is out, all that stuff's on the table, so we're kind of aware of what the day is going to give us. We understand that. The first couple of minutes of the day, it's hard to tell whether we're going to go up or down. We're going to be bullish or we're going to be bearish or we're going to chop sideways. Once you get into this time frame, it's a little easier to read. And then when you're over here, you're just sort of like in no trader's land, okay? It's a crapshoot over here. Anything can happen. The stuff that you're seeing might not be so reliable. And again, it's also important that if you feel compelled by the natures of this world that you must trade, at least you know what time frame that you're in and you can prepare accordingly with position sizes. So again, remember this, guys. One of the reasons, the first thing, you have your plan, you have your process, and you have your execution. But it really matters when you decide to execute. Your chances of success as a trader will come within those first 2 hours of the day. So it's very important that you pay attention to what's happening, pay attention to the levels on your stocks, and pay attention to your trading plan, because this is your time to execute. If you screw it up in between there, it's going to be hard for you to recover, because statistically the market is not in your favor. So anyway, I hope this helps out. As always, if you need some more questions answered, send me anytime to my email, support@thelincolnlist.com. Until the next whiteboard, take care.